Good morning, everyone, and welcome back to the Daily Hunt for Multibaggers. It's Friday, October 31st, 2025, and we've got a busy show for you today.
That's right, Ethan. Our AI has been sifting through a truly massive amount of market commentary and data collected yesterday, October 30th. We saw a lot of chatter across a wide range of stocks with some very strong opinions on both sides.
Yeah, real mixed bag. There were definitely some promising growth stories highlighted, but also some significant red flags that our system picked up. It felt like a day of high stakes and strong emotions out there.
Indeed, the overall market sentiment seems quite polarized today. We have a few interesting candidates, but also several that, well, should probably be approached with extreme caution.
All right, let's jump right into it. First up, we're looking at Beyond Meat, ticker BYND. Now, I saw some brave souls on social media making some pretty aggressive plays here, talking about a rebound from recent lows and, some bullish intent. It feels like there's always that potential for a bounce with a name like this.
While the social media chatter might point to short-term speculative plays, Ethan, our AI-generated insights tell a different story. The KPIs are screaming stay away here. We're looking at deeply negative net profit margins, shrinking revenue growth at nearly 20% negative, and a negative price-to-book ratio. That, quite frankly, indicates that liabilities are exceeding assets.
Ouch. I remember us rating BYND as stay away or speculative gamble multiple times in the past.
And the data supports maintaining that stance. Despite any short-term YOLO posts, the fundamental picture is concerning. Our analysis classifies Beyond Meat, BYND, as a stay away. Next up, Meta Platforms, META. This one has seen a whirlwind of discussion recently, especially with its AI investments.
Yeah, absolutely. There's a strong argument that Meta's massive AI spending isn't waste at all. It's, rocket fuel for future growth. Users are talking about an unbreakable competitive edge and a potential re-rating to a much higher valuation. Plus, their Q3 earnings were really strong, beating estimates, and many see the recent dip as a fantastic buying opportunity.
I hear the optimism, Ethan, but we have to balance that with the cold, hard numbers and market reaction. While Q3 revenues and profit margins were strong, the market's response to Meta's increased AI spending has been mixed. Multiple analyses flagged a high debt-to-equity ratio of over 25, and analyst concerns about future EPS growth being limited by these capital expenditures. Some chatter even indicated a 10 to 15% stock fall following these announcements.
It's true that their prior ratings for Meta were consistently buy, but yesterday's analysis was very split, with several stay-away verdicts mixed in.
Given that strong underlying business, but also the significant financial leverage and investor caution regarding future earnings dilution, our consolidated analysis for Meta Platforms, META, leans towards a cautious buy. It's a downgrade from its previous consistent buy ratings.
Moving on to Novo Nordisk, NVO. I saw news about their bid for Metsera, which could be a strategic move to boost their pipeline and competitive position in the long run. Expanding capabilities, that's generally a good thing for growth.
On the surface, an acquisition bid might sound good, Ethan, but the market's immediate reaction was quite negative. The stock was reportedly down over 3% in the Danish market on the news, and there's chatter about their core product, semaglutide, losing competitive against rivals like Eli Lilly's tirzepatide. Their current price is significantly lower than its 52-week high, and the historical performance shows a pretty steep decline over the past year.
We've seen NVO bounce between buy and stay away in our prior ratings, with the most recent being stay away.
And the data today reinforces that. Concerns about competition, a negative market reaction to the acquisition, and the stock's overall performance suggest that for Novo Nordisk, NVO, it's best to stay away.
Next, let's discuss Amazon, AMZ. This one had a lot of action.
Amazon had an incredible Q3, Brooke. Revenues and earnings topped estimates, their cloud business is booming, and new AI chips are poised to unlock billions in revenue. Users are celebrating massive gains, talking about how bears are getting margin called. It's a clear growth story with huge momentum.
While Amazon certainly delivered a strong Q3, which is reflected in positive revenue growth and net profit margin, a couple of our analyses flagged a very high debt-to-equity ratio of almost 48. That's a significant amount of leverage that can introduce considerable financial risk. There was also some skepticism regarding the valuation of projects like Cooper and a high PE ratio, implying that a lot of future growth is already priced in.
Historically, AMZ has been a strong buy for us, with a few cautious buy and stay away ratings mixed in recently.
Considering the strong Q3, but the underlying leverage and valuation concerns, our consolidated analysis suggests that Amazon AMZ warrants a cautious buy. This reflects a slight downgrade from its more frequent buy ratings, emphasizing the need for due diligence on the debt.
Coinbase, COIN, had a lot of buzz today. Despite some bearish posts trying to call it cooked, the overall sentiment in the community was actually quite bullish, largely dismissing the FUD. Plus, the company just smashed its Q3 earnings, beating estimates by a whopping 45%. Strong trading volume, high net profit margins. Sounds like a winner to me.
Yeah, a fresh entry for the daily hunt. My take for Coinbase COIN is a definite buy.
Based on those solid numbers and market sentiment, I concur. Buy for Coinbase. Next, Intensity Therapeutics, NTS. Ethan, the posts flagged a significant intraday surge tied to positive clinical trial results for their NT230-6 treatment.
That's huge news for a biotech, Brooke. Positive phase 1/2 findings with immune infiltration and a favorable safety signal. This kind of news-driven momentum can lead to big moves. It shows promising scientific advancement.
Clinical advancements are exciting, yes, but let's look at the financial health. Intensity Therapeutics currently has a negative earnings per share, a net profit margin of 0, and a very high debt-to-equity ratio of over 5.7. Positive trial results might create a temporary surge, but a sustainable investment needs a solid foundation. This is a first-time mention for NTS.
Those KPIs certainly paint a stark picture. For Intensity Therapeutics, NTS, we have to classify it as a stay away. Now, MicroStrategy, MSTR. The company recently reported strong Q3 results, largely driven by mark-to-market gains on its substantial Bitcoin holdings. That kind of exposure to crypto assets can be a real differentiator and a strong bullish point for growth investors.
While the Bitcoin holdings certainly influence their Q3 profits, Ethan, we can't ignore the core financial structure. The debt-to-equity ratio is extremely high at over 16, indicating substantial financial risk. The stock also has a very high beta of almost 3.85, meaning it's incredibly volatile, and currently its price is less than half of its 52-week high.
This is a podcast script with two speakers, MSTR, as a speculative gamble.
Given the high leverage, extreme volatility, and significant depreciation from its peak, our analysis for MicroStrategy, MSTR, reaffirms a stay away.
Let's talk about Reddit, RDD. The platform announced a Q3 earnings beat, which caused quite a stir.
Absolutely. Reddit crushed its Q3 earnings and revenue estimates. There was strong growth, expanding margins, and users are expressing real surprise that the stock isn't soaring higher. They see it as undervalued, with predictions of hitting new all-time highs by Christmas, plus whispers of S&P 500,
The revenue growth is indeed impressive, Ethan, at nearly 78% year-over-year for Q3. However, even with that strong performance, the price-to-earnings ratio is still very high, currently over 86. That kind of valuation means a lot of future growth is already priced into the stock. While community sentiment is very optimistic, that high PE introduces significant risk. We've consistently rated RDD as stay away.
Fair point. The enthusiasm is there, but the numbers do demand caution. Our verdict for Reddit, RDD, remains a stay away.
Moving on to Eli Lilly, LLY. This stock consistently pops up on our radar, and today is no different. They're showing incredible growth with products like Mounjaro and Zepbound. Record revenue surges, upgraded annual outlooks, they seem like a clear leader in their field.
The KPIs absolutely back that up, Ethan. They have exceptional revenue growth at nearly 38% and a robust net profit margin of almost 26%. The current price is significantly closer to its 52-week high than its low, reflecting strong investor confidence. While the PE and PB ratios are high, this is often characteristic of high-growth pharmaceutical companies with strong product pipelines. We've consistently rated LLY as a buy.
And today's analysis is no different. For Eli Lilly, LLY, it's a strong buy.
Agreed.
Next is Chipotle, CMG. The posts suggest a third guidance cut this year, highlighting collapsing margins, wage pressures, and consumer fatigue.
Well, while there are those concerns, Chipotle is a recognized brand, and one user even mentioned buying shares today believing the problems can be fixed. Sometimes a dip can be an opportunity.
That's a high-risk gamble, Ethan. Our analysis shows a stock price drastically lower than its 52-week high, indicating a substantial decline. Revenue growth is a meager 3%, and despite that, the price-to-earnings ratio is still relatively high. User complaints about declining quality and shrinking portions, coupled with a high debt-to-equity ratio of over 135, point to significant underlying operational issues. This is a first-time mention for CMG. Those are some tough numbers to ignore. For Chipotle, CMG, it's a clear stay away. Last but not least, DoorDash, DASH. There's a lot of talk about their future, with some exciting partnerships like with Waymo for autonomous delivery. That's a forward-thinking move that could drive efficiency.
It could in the long term, Ethan, but in the short to medium term, our AI-generated insights paint a very bearish picture. The price-to-earnings ratio is astronomical, sitting at almost 139. Their net profit and operating margins are incredibly thin, making them highly vulnerable to cost pressures like increased driver benefits and regulatory surcharges. Users are expressing widespread fatigue with high delivery fees, which directly threatens their order volume and profitability. This is a first-time mention for Dash.
That PE certainly gives me pause.
It should. High valuation, thin margins, and consumer pushback make DoorDash DASH a stay away.
All right, so after all that deep diving, let's round up our top candidates for further analysis today. Investigate as buy, Coinbase Global, COIN, Eli Lilly and Company, LLY. Investigate as cautious buy, Meta Platforms, META. Amazon.com, AMZen. Investigate as speculative gamble, Reddit, RDD.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses.
The market is a wild place, and knowledge is your best asset. Thanks for joining us on the daily hunt for multibaggers. We'll be back next time with more AI-generated market commentary.
Have a great day and happy hunting.